Welcome to The Explainer. Today, we're diving deep into the chapter on the dissolution of a partnership firm. If you've ever wondered exactly what happens to the money, the assets, and the debts when a business closes its doors for good, well, you're in exactly the right place. We are going to completely unpack the legal and financial steps required to cleanly and legally shut down a firm.
Okay, let's just take a quick look at our roadmap for today. We're going to cover partnership versus firm dissolution, the modes of firm dissolution, rules for settling accounts, the realization account, and finally, those all-important final journal entries.
Right, let's jump straight into Section 1, Partnership versus Firm Dissolution.
We absolutely have to start by drawing a hard legal line between these two concepts because they are not the same thing. Dissolving a partnership, that just changes the ownership structure. Maybe a partner retires, or a new one comes on board, or the profit-sharing ratio shifts. The actual business, though, keeps right on running. But dissolving the firm, that means the whole entire business dies. The economic relationship is completely terminated, everything is sold off, and all liabilities are cleared out. The whole shebang.
And the legal backbone for this is found in Section 39 of the Partnership Act of 1932. It defines the dissolution of a firm as the total breaking or discontinuance of the relationship between all the partners. So the absolute crucial point to remember here is that once this legal threshold is crossed, the firm's existence is over. Period. No new business can be transacted. From that exact moment on, the only allowed activities are the ones strictly related to winding things up. Selling assets and paying off creditors.
Moving on is Section 2, Modes of Firm Dissolution.
So what actually triggers this ultimate shutdown? It doesn't just happen out of thin air, right? There are specific legal pathways. First off, it can just be by agreement. All the partners simply consent to close up shop. Nice and easy. But it can also be forced. Compulsory dissolution kicks in if all the partners become insolvent or if the business itself suddenly becomes unlawful. Then we have contingencies. Say the partnership was only formed for a specific 5-year term or a single venture that's now finished. If it's a partnership at will, well, a simple written notice from just one partner can trigger the whole thing. And finally, a court can step in and literally order the dissolution if there's a case of partner insanity, permanent incapacity, or some serious misconduct. So basically, a firm closes either voluntarily, through unavoidable life events, or by strict order from a judge.
All right, Section 3, Rules for Settling Accounts.
Once that trigger is pulled, we have to settle the accounts. And listen, you can't just divide up the cash in the register and go home. First, we've got to talk about losses. Before anyone gets a single dime back, the firm has to cover its deficiencies. And if the accumulated profits and capital run dry, well, those losses are paid by the partners individually right out of their own private pockets. This is a massive point to understand. Limited liability is absolutely not going to save you here.
So you've sold off the machinery and the inventory. Where does all that cash actually go? The law mandates a super strict hierarchy here. Step 1, you absolutely must pay outside creditors first, always. The bank, your suppliers, any third-party debts. Step 2, once the outsiders are completely paid off, you repay any loans or advances given to the firm by the partners themselves. Step 3, then and literally only then do you repay the partners' capital contributions. And finally, Step 4, if by some absolute miracle there is a surplus left over, it's distributed to the partners based on their agreed profit-sharing ratio.
But wait, what happens when a partner has their own personal debts alongside the firm's debts? It gets tricky, but the law strictly separates business and personal obligations. A firm's property is used first to pay the firm's debts. Makes sense, right? If a partner has private debts, their private property is used first to pay those private debts. It's only if there's a surplus in the private estate that it can be used for the firm's debts. And conversely, only if a partner has a surplus coming to them from the firm can it be used to pay off their private creditors. It's perfectly designed to ensure everyone's distinct creditors get a fair shot at the correct pool of assets.
Let's head into Section 4, the realization account.
To actually process all these complex payouts and legal hierarchies on the books, accountants use a really highly specialized tool. The realization account is a temporary nominal account open solely for the purpose of dissolution. You transfer all your assets and outside liabilities straight into it. I like to think of the realization account as a giant liquidation yard sale. You drag all your assets out onto the lawn, slap a price tag on them, use the cash you make to pay off all those angry creditors waiting in the driveway, and the final balance at the end of the day tells us if the yard sale was a net win or a net loss.
Let's cleanly organize this chaos, shall we? On the debit side, you sweep in the book values of all your assets. Below that, you record the actual cash flowing out to pay off liabilities and any dissolution expenses. Then, over on the credit side, you sweep in the book values of your external liabilities. And right below that, you log the cash flowing in from selling off those assets. At the very end of all this, the difference between the two sides represents your final profit or loss on realization, which gets transferred straight over to the partners.
And that brings us to Section 5, Final Journal Entries.
So how do we actually write this all down? We're going to translate that realization table into our final journal entries. The absolute first step is clearing out your old balance sheet. You want to move all assets and external liabilities directly into the realization account at their book value. So you debit realization and credit your individual assets to close them out. Then you debit your external liabilities to close those and credit the realization account. You are essentially emptying your firm's pockets directly onto that yard sale table.
Step 2 is liquidating the assets. When an asset is finally sold for cash, we don't use the asset account anymore, because remember, we already closed it. Instead, we debit the bank account to reflect the real money actually coming in, and we credit the realization account to log the revenue from our yard sale.
Step 3 is just the exact reverse. It's time to discharge those liabilities. When we finally pay off those outside creditors, we debit the realization account to log the expense of the settlement, and we credit the bank account to show that cash flowing right out of our hands.
Now, step 4 is absolutely critical. Remember our hierarchy from earlier? Outside debts first, then partner loans. Notice this huge exception though. Partner loans are paid off directly from the bank account. You debit the partner's loan account and credit the bank. Partner loans are purposefully kept entirely 100% out of the realization account. Why? Because the realization account is strictly for third-party external settlements to determine the true external profit or loss. Partner loans, that's an internal matter, so it's settled afterward. Finally, step 5. The dust has settled, the assets are completely sold off, and the creditors are paid. You balance the realization account. The very last accounting act is allocating the final profit or loss from our yard sale directly to the partner's capital accounts. If credits exceed debits, hey, it's a profit, you credit the partner's capital. But if debits exceed credits, it's a loss, and you have to debit their capital accounts, shrinking their final payout based on their agreed profit-sharing ratio.
Understanding these rules inside and out isn't just about passing an accounting exam, it's about real-world risk. Because as we saw today in a dissolution, it's not just about business math. I'll leave you with this question to chew on. If your partnership firm dissolved tomorrow, would your liquidated assets be enough to cover your third-party debts, or would your personal wealth be on the line? Thanks for joining me for this explainer, and I'll catch you next time.